Welcome to Total Money Management. It's Jacob, and I'm back with Mr. Steve.
Mr. Steve. No Tom again?
No Tom again this week.
He's still in limbo.
He's on his holidays.
Still in limbo.
Tom, thinking about your brother? All right, so...
Look, we've even got a cup there for you, Tom.
No, that's mine.
Oh, is it? Oh.
I've been drinking his
Oh,
water.
no, Jesus, you have been given the arse, Tom. Sorry. Come and collect your pay.
You're sacked.
Righto, what do we got?
Well, we've got a. There's a lot to say and nothing to say. I think that you put it quite poetically in this week's newsletter. But in all seriousness, we need to wait and see how the Trump situation goes.
Yeah.
We're thinking it might be a bit of a melt up until January, February.
Might be a little volatile.
Yeah.
I think that what I'm... there's a lot to say and nothing to say. There's a lot to say because there's a lot going on, but there's nothing to say. And what I mean by that is we spend our lives deciphering current events and what it means for the future, in our case, of our stock investments or our property investments or our investments as a whole, right? And what I'm sort of saying with there's nothing to say is I've been doing this now for about 25 years, and I've come to the conclusion that the absolute dominator of your investment returns will be valuation. Now, you can talk about all sorts of stuff, but if something like the US stock market is really expensive, it's a really hard slog. Now, it's a really hard slog over the long term. So, yes, people can say, oh, man, you've been banging on about CAPE since 2019 or even longer. But my argument is, yes, but we've made money in specific areas like energy, right, or individual companies or ETFs. So what I'm saying is it's not just because something is expensive doesn't mean, and you know, you and I were talking about this at a coffee shop, it doesn't mean there's absolutely nothing to do.
Yep.
But it just means you've got to dig down second and third layer to go, okay.
I think it's perfect timing because we're getting a lot of questions at the moment saying, I really want to from just randoms, really want to invest, but you guys are saying everything's expensive, so I'm sat on a bunch of cash. Yeah. There's nothing wrong being sat in cash.
If Warren Buffett thinks it's all right.
If you don't know what you're doing, more specifically, it's actually a really wise decision.
Yeah.
But what we're saying is there's certain the overall market's expensive, but there are places you can invest more shorter term, which we hunt for. That's what we do.
Well, yeah, you can use well one as a shorter term thing. Emerging markets are really, really cheap.
Yep.
Right? So you can look at places to invest. It's just you've got to be cognizant in terms of diversification. When the US market crashes, generally everything else goes down with it. Yep. Right? Now, it may be illogical, it may be irrational. There may be countries like Brazil where the CAPE's at 11, Poland and places like that, they will still get cheaper, right? Because what you get is someone shouting fire at the movie theatre, right? And everybody just runs for the door, right? Nobody sits there and goes, oh, I'll just have a think where the fire is. Maybe I've got a bit of time. No. Everyone just heads for the door, right? And that's what that's why I'm sort of saying there's nothing to say. Because if you look at valuations, you just go, oh, man, this is...
The macro valuations are so overpowering.
Yeah.
Well, I think Charlie Billier says it best. Stocks all-time highs, home prices all-time highs, Bitcoin all-time highs, yippee! National debt all-time highs. CPI inflation above 3% for 41 straight months. That's a long time.
Yeah, it's nearly 4 years.
And then the Fed's cutting rates again this week.
That's what I mean. You just look at that and go, okay.
Yeah.
Everything's at an all-time high.
But yeah, for me, practicing patience in a market where everyone's running around like headless chooks is very difficult.
Yes, but you got to do it.
Yeah. Learning how to do it. So what?
Or you got to rebalance every week.
Yeah. Yeah, well, you on yesterday, well, it'll be a week when this is out, but one's done well, let's take some money off the top.
Yeah.
You've got to make sure that you can do that.
Well, that's what Warren Buffett's doing, right? He's had an unbelievable run since he bought Apple in 2014. He's had an insane run since he bought Bank of America, I think in 2011. Okay. When the world's best investor says, I think I might start selling down some stuff, that's when you got to sit up and take notice, right?
Yeah. And I think the one of the first lessons I learnt from you, it might have been, 7 years ago, 8 years ago? It's been a while now.
Yep.
Where you were like, what are you actually investing for? What are your goals? Are you counting numbers, or are you wanting to enjoy life? And
I think the last 10, 20 years, Jacob, what I've seen is a lot of young guys like yourself, but generally just people who just gamble, speculate, we just seem to be in the grip of mania.
Yeah.
And it's so, it's like I've been saying about house prices. They've been so high for so long, you think this is the new normal, right? But if you look back at history, you just see the signs of there is just more and more debt pouring in, right? And it's got to stop.
Yeah. I think particularly with my generation, I mean, I'm 30, we've been taught that one income stream is not appropriate.
Yeah.
You can't survive.
Yeah. Even if it's 200,000,
even if it's
like people in Sydney are earning and they're going, dude, I still can't afford a property.
Yeah. I mean, I sit quite comfortably myself, but I've got a bunch of mates earning $350 and they're not floating. And you can argue that their lifestyle is ridiculous, but they've also got multiple income streams.
Yeah, yeah.
So we've been taught that, and it's not the 50, 60-year-olds. They had a job, they were stable, had a house young, all that, and that's fine.
Yep.
But the newer and newer generations are going, well, shit, we can earn money by clicking buttons now, and then they might get a 0-day option and when they turn 18 and earn a bucket load.
Yeah, yeah. My son, my son is coming up to 18 and I've had to deal with that because I'm sort of saying to him, listen, mate, you got to get a job and, and when I think about it, most, as I've said before, and I'm really critical, young people are poor bastards. They've got 2 or 3 jobs, or they've got a job at the coffee shop and it's 20 hours, right? Which means they get, $400 a week, which is not enough to live. I was talking to one of the local coffee shop people, young lady, I think she's about 20 or 21, I think. And she's in the 3rd year of a 4-year degree, right? And she works a lot at the coffee shop. Funnily, because she said, I see more of you than I see of my family, right? Because I go up and have a lot of coffee.
So you got nothing else to do, mate.
Yeah. Tax deduction.
Yeah.
But I said to her the other day, she said, I'm on holidays and I don't go back for 5 months, right? And I said, oh, right, okay, wow, and she went, it's great. And I went, really? And she went, yeah. She said, I can work here. I'm living with mum and dad. I'm working here and I'm, and I said, oh, so I suppose, you'll travel when you get your job, when you get your qualifications. She was like, nah, I'm just happy. She said, I'm just happy working here. And I said, don't you want to move out from your mother and father? And she was like, nah, it's great. And I said, so obviously you don't pay any rent. And she went, nah, don't pay any rent. But you know what I mean? Like when I was that age, I'd moved out like when I was about 16, I think.
Yeah.
And I'd moved out, then moved back, then moved out again, then moved back, then moved out again, and when I look at that, like you say, everybody's got a side gig or a side hustle or they're going to do a website or like you say, there's just this, I'm going to buy Bitcoin, I can probably make it rich in 12 months. I'm going to buy NVIDIA. I'm going to buy options, all of this sort of stuff. And that's what concerns me. But as an older guy, I've got to look at it and say, yeah, but Steve, maybe that's the way, life is now.
Well, it is, and it's the people that make it quite well that actually do their research.
Yeah.
But we all learn lessons. Like I remember 2021, I rinsed half my savings account, which wasn't a lot then, on speculating on shit.
Right. Okay.
And then so I luckily learned early, and it wasn't expensive, and then you move on. Yeah. But most people go through that and go, fuck, I'm not doing that anymore.
Well, they can't.
Yeah.
But that's what I mean. That's where I think there's a lot of people out there who don't really understand the way markets cycle and valuation and stuff. And I know we harp on about it, but it's really, really important because, you know, as I sort of say to people, look, the only thing, Ben, I've got going for me is I'm coming up to 62 and I've been doing this for a while and I've read a lot of history. So I think I know what's going on. I'm not just saying, hey, you know, buy a property and buy stocks. It's all good. Don't worry about it. Because that, you know, that only works for a certain amount of time. And when it doesn't work, what's the indicator? And the indicator is markets are really crazy in terms of valuation and everybody's in the tent, right? And this one, you know, we're showing up here, you know, Americans have a record amount of their assets invested in stocks, exceeding the highs seen during the internet bubble that imploded in 2000. How can it be different?
Yeah.
How can you say to me, Steve, that's all, it's different this time because of X, Y, Z? It's like, mate, the economies are still the same.
Yeah, it could well go on for longer. The bubble in 2000 looked like it was relatively sharp. This has been up and about there for years now.
Yep.
4 or 5 years.
Absolutely.
So it could go for a longer, but what we're seeing is it will come back to the mean.
It blows up eventually.
Yeah.
Right? And it's at the point where everybody's calling you an idiot that you generally get the idea of it's close to blowing up. Right? And I think we mentioned last week about, you know, one of the indicators is people saying to Warren Buffett, you silly old toaster, you know, you should have bought NVIDIA or all this sort of stuff. You know, that's when you really go, okay. And the thing is, it's 35-year-old blokes, you know.
It winds me up so much. Well, Buffett's lost it. Are you joking me?
This is from a bloke who's been in markets for 3 years or something. Yeah. You know, it's like, oh, right, okay.
Yeah, and just because he's done a couple 100% in the video, he's an absolute genius.
Yep.
Anyway, standard deviations indicators, which is obviously... So what this chart's showing is it basically means that 7 feet people are going to continue to walk through the door.
Yeah.
If you've got a group of 100 people and the average is 5'7", this is saying that the last 20 have been 8 foot.
Yep.
And what we're saying is that's impossible to continue.
Yes.
It is actually impossible to continue.
Yeah, when it's exponential, like geometric, like the markets, you have to get, 6% of 200 is more than 6% of 100. Now, I know that sounds a bit like Steve, but what I'm saying is it's scaling.
Yeah.
Right? So eventually you get to the point where you go, well, hang on, we just need so much more money to continue growing. And if your money is coming from private sector debt with people borrowing, that's where you start to say, well, hang on, there's no one left that can borrow money. And that's our argument. Our argument is, particularly in Australia, household debt is so high, that we're running out of people to borrow money to keep the property market going. And that's what the US discovered in 05 and 06. That's why they had the GFC, because they'd lent to everybody who had a heartbeat.
Yep.
Right? There was just basically, it got to the point where there was nobody left to borrow, right? And that's when it stopped.
Yeah, and we're saying, look, there's no one left to borrow, so they drop rates, but there's still no one left to borrow. It's all good and well you're dropping rates, but they'd rather pay the debt off.
Yep, and that's why I'm complaining a little bit about when you're negatively geared. You need to think about that, because what you're doing is saying, I'm hoping for the capital gain, right? Now, on the way up, you look fine. Who cares if you're losing $200 a week? Right, 10,000 a year if the property's going up 40. The problem is when you get the flip side, which is I'm losing $10,000 a week and I'm losing 40 grand a year with the property sinking. That's when you get a problem, right? Because at some point you go, hang on, what am I paying for this dead,
I've got to do this now for 10 years.
10 or 20 years and it's not working and interest rates are at 6%. What the hell am I doing, right? That's why you then say, well, hang on, now do I get out with a loss? I mean, how bad of a loss am I looking for?
And we're seeing that already, right? The house sales up in, what's it called?
Distress sales.
Yeah.
But this is why I say, when you're in a market, not everybody makes money. So you got to make sure you're one of the ones that make money and not lose money, right? And there's too much talk about how easy it is to make money.
Yeah. Well, one of our principles is don't lose money.
Well, that's the first one, right? Think about, how do I avoid losing money,
Wednesday, Capes at 38.2.
Beautiful.
That's
Lovely.
It's terrifying. So what was it through the .com? 44.
44 it reached in, I think, January or February. But from 96 to 2000, it doubled.
Mm.
Right? Then it halved. Then it doubled. And then it halved.
So the long-term Cape is about 20 now. Like the modern-day Cape is about 20.
22 or something.
Yeah.
But that's, I don't use that. They argue from, I think it's about 95, that it's been about 22.
The modern day Cape.
Yeah. And again, this is what you see. People start to go, yeah, but if you change it to XYZ, it looks reasonable. And it's like, okay, have we suddenly decided to change the definition to accommodate a higher valuation?
Yeah.
And that's why I say if you go back and look at it, the economy is still the same as it was 40 years ago. People buy stuff, people have wages, people borrow money. There's nothing different. Oh, the internet. Yeah, I know the internet, but the internet means what? Well, it just means people still have money. There's still rich people. People still speculate. So what I'm saying is nothing's changed. But what we do is try to look for things to go, Steve, it's different this time.
In a different lens, yeah.
Oh, we've got cryptocurrency now. Okay, but it's still people get paid. People work. There's a government. You've got to pay taxes. Imports, exports. It's still the same. It's still the same. But they keep, because it goes on for a long time, they think that it's different. And what we know is if you have a look at that there, just go back one actually. If you have a look at it in 2000, right? Up here, you're saying you've had an 18-year bull market. Right, 18 years. Imagine up the top there going, man, things look expensive. People would shoot you.
Yeah.
Like, what were you idiot? 16% per year for 18 years. The house prices are booming. World trade's coming. We just got over the Asian financial crisis. Man, it's kicking in.
Bang. Yeah.
That's why I say I just keep looking at valuation and going, look, I can make all the stories I like, but it ultimately Ben Graham said in the beginning it's a weighing machine and in the end it's a voting. In the beginning it's a voting machine and in the end it's a weighing machine. Right? In the beginning, people are going, man, it's great, right? There's euphoria, lots of emotions, all this sort of stuff. In the end, people go, oh, because eventually you have to say, we're not going to make any money. And eventually, what do? You sell.
Yeah. And that's when it turns again.
That's when it turns again, right? When enough old buggers like me go, now we're going to buy stocks, right? Because everybody wants to sell them.
So this is what we were talking about before at the Cape at 38. We've got here, what was it, about 14-ish?
Yep.
And then, so that's 1871. And at the top end here, now the average is about 22.
Yeah.
So modern day average, and then you can kind of take something in between at about 17.
Yep. But see how it goes above that line and below that line.
Yep.
Right? That's that dotted line is the trend.
Yep.
Right? So if we're all absolutely, completely rational, it'd rise about 3% per year, real terms. What I'm trying to point out to people is if you look at that chart, and there's a chart very similar to it in our macro valuations or market cycles session, we might put that up next week.
Yep.
What you see is it's exactly the same carbon copy with high Cape ratios and low Cape ratios, right? And yes, it'll be years, but as you know, we talk about asset allocation and rebalancing, right? So at the top of the market, you shouldn't have a lot of money in there, right? Because will you lose out? No, because if the market halves, you'll be going, oh, thank God I didn't have all that money in, right?
I'll just put it in now. Yeah.
Well, that's people go, and I think I mentioned this a couple of weeks ago. There was a guy on a well-known finance podcast, right? And he went, if you'd have been out of the US market, you'd have missed out on 38%. And it's like, okay, well, what happens if the market crashes 50%? Right? And my argument is your 38 disappears, Buster.
Yeah.
But people like that go, oh, yeah, but, you buy some more. And what I'm saying is if you don't understand valuations, then you don't know when to sell.
Yeah. That's the question, right? That's the big question. When do you sell? What does
you
it
don't
look
even
like?
know when to buy, right? Because you don't even understand cycles. So it's just like, The US market's going up. Oh, cool. Let's just dive in. Right. Okay. So when are you going to sell? I don't know.
Never, yeah.
When
50 years.
When that guy on the podcast tells me to sell, and that'll be after it's fallen 40%.
Yeah. Oh, but when it falls, they just say dollar cost average in.
Yeah.
So, I mean, we could talk about that all day.
When you're unemployed.
Yeah. Thursday, we've got wages growing somewhat to match inflation. This is Australia or America?
Yeah, this is, I just wanted to put this up.
Australia, yeah.
In line with what we talk about with what we say is the new normal is you're going to see more people employed by the government. Government is going to get bigger. We talked about that a couple of weeks ago. And what I'm trying to point out here is this will probably push wages up because the government is now competing for people. So I think we had last week, maybe the week before, we had the police got a 40% pay rise.
Yep.
There's going to be a fair few people going, what, I might become a copper.
Yep.
Right? So that then says, oh, well, there's a industry out there going, man, we can't find any more people. It's like, no, mate, they're all police or they're all nurses or they're all construction workers or something, right? So the government is leading the charge and I think we'll get more and more of this, particularly if we start paring back immigration.
Yeah, well, we're going to need to keep people in Australia as well.
Yes.
Because more and more people are moving to the UK or the US, especially skilled individuals, skilled individuals.
There's a real global push to get all the skilled migrants wherever they are, right? If they're in Africa, if they're in India, if they're in China, if they're in Bangladesh. Pakistan's had a huge loss of brain drain. Because the economy's toast, it's an absolute, shit show, to be quite honest. And if you're wealthy in Pakistan or you're a doctor, you look at Australia and go, man, they're paying big money and I can walk straight in. Why wouldn't you? Even if you said, look, we'll go over there for 10 years, wait till Pakistan tidies itself up and we'll come back.
Yep.
Friday.
What's going on Friday?
Oh, poor old Friday. Same story.
Close your eyes, we're talking about houses. Yeah. Close your ears.
Yeah. Just some standard stuff. We know about that. Let's get on to the bonus. What's the bonus about?
Oh, you've just decided to put a bunch of numbers up here.
Now, listen, there's two charts there. Where's the other one? Yeah, there you go.
Regardless of the asset class you favour, rebalancing is the way to ensure you don't lose everything. So is that...
That's Bitcoin.
That's Bitcoin. Is that my chart? No.
Yeah. Yeah, that's and the one before it is my chart.
Yeah.
Which is, as we said last week, we put in, Bitcoin at 75 and this week was like Bitcoin at 93.
Yeah. I wonder what it'll be when this airs.
Yeah. So
I'll be on my jet somewhere.
In my defence, I did say it would go to 100,000 if Trump got elected.
When did you say that?
I did.
That's bullshit.
Mate, it's recorded. It's recorded.
I'll go find it.
Because I remember thinking, I was listening to it and I went, yeah.
Yeah. Rebalancing, well-won.
That's the point. That's the point, right? Look at that next one, mate. Just move to the next one. Right now, look at the volatility. Right, look at the declines. 33, 78, 55, 31, 84, 30, blah, 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 right? You're looking at that going, oh man, right? Yeah. Now look at the bottom one.
Yeah. 1,600. Right? That's in 2010.
Loses 94%. Yeah. At that point, people are going, oh, Jacob, you're a dickhead. You bought Bitcoin. You're a loser. What is that? 1,600%.
Yep. So I started in 2015 here. Just after.
Crikey, did you?
Yeah. Just after this decline.
Right.
Yeah, so 85%. Actually, just before the decline, I got in because I was like, oh, shit. Like anyone else. Holy shit, Bitcoin's doing well. So I got in here, lost a shit ton of money. And then decided decided to learn about mean revert, all this stuff.
Yeah, well, that when you and Jacob came on board.
Yeah.
Maybe a year later or so.
Yeah, that's when we met.
Yeah. But our point is, for God's sake, rebalance, right? Really seriously rebalance. And you need to be careful with Bitcoin because it can go to zero.
Yes.
Right? It's what you need to be. And why we say that is because you get a buy the dippy, and it ends up dipping to zero.
Well, it goes 94% and then a bit more.
That's what I mean.
It can still go 100% further from 94%.
Yeah.
People don't
well,
understand.
there's the old argument. What's a stock that's down 90%? A stock that's down 80% and halved again.
Yeah.
Which is true.
Yeah.
Right. And yes, the pain gets greater and greater as it falls.
Yeah. Trend following strategies on Bitcoin are the way to go, FYI.
Right, there you go. Okay,
Short
folks.
story.
Hit him up, don't talk to me. What would I know? I'm a silly old bugger who talks about stocks.
Oh, you're all right, mate. Short story. So we've got country compositions here. So that's basically saying the whole world's having a America party, right?
Everybody's in the S&P and the NASDAQ.
Yeah, which is terrifying if we have a turnaround.
No, if.
Well, when? Sorry.
Oh, Lordy.
Sorry, guys.
Oh, Lordy, that's a biggie. That's a biggie. And even all the Americans are in.
Americans are in the equities. We've got overseas people all in America.
I double that chart. That's the one from Monday.
Yep.
Dementia's kicking in, Stevie.
Yeah.
Right, and then the next one, just pointing to Apple as you can see why WASA sold, right? The Apple price to sales ratio is 9, right? And the average is 5. And we put something in this newsletter, I think it might have been a few months ago, a guy called Scott McNeely, who was running some company, I've lost it, but the sales ratio was 10, and this was in the .com, right? And he said to the shareholders, "What the hell were you thinking?" Basically saying to them, "You're idiots. You're paying too much for my stock." And Apple's now at 9.
Yeah, lo and behold. Well, when it's been, look at the PE ratio up at 37 in 2000 and when was this? 2020-ish. And
no, 2024.
No, here I'm looking.
Oh, right. Sorry. Yeah.
So it's overvalued.
Yep. Look at when Buffett bought it. That's probably about when Buffett bought it. And if you look at it, the PE was about 12, I think.
Yeah.
Which now you look at it and go, oh, man, that's insane.
What a genius.
Well, as I said, in Will 2, we do, buy the cheap ones, and the IT sector in 2014 was at the bottom. So he just went and bought the best company in the worst sector.
Yeah.
And that was that's a Dave Draymond strategy. Contrarian Investment Strategies, a really good book. If you want a really good book to read it. It's a bit old, but it's still great. But shorthand, buy the best companies in the worst sectors. So go to energy and buy, Exxon or Chevron or something. Hence Warren bought Oxy Petroleum.
Yeah.
Right? He's a cheeky old bastard.
Just knows what he's doing. All right, so Holy Trinity. You want to talk to us about this? This is from one of our coaching sessions, right?
Yeah, this is out of buy low, sell high. And there's a couple of points there. One down the bottom, when you buy is often more important than what you buy, right? And again, people go, oh my God, that's market timing. Yes, it is, folks. And things are cheap, you buy them. When they're expensive, you sell them. If you buy, we use this all the time. If you buy Microsoft in 2000, you wait 13 years to get your money back. By the way, Microsoft, bad call on the bloody Microsoft 365. It was $109 and they just stiffed me for $159.
They know you're making money.
50%.
Yeah. Well, you'd pay it.
50%. Now, listen, there's a bloke out there called Michael who may or may not work for Microsoft. Mate, go and do something about it. That's bullshit. 50% pay rise. And second part of that, people rabbiting on about, it's the government spending so much money. Yeah, well, try that on again. It's not the government, it's companies that have got these bloody oligopolies. Anyway, I'm stop raving. Righto, the other thing is the Howard Marks quote there. There are 3 ingredients for success: aggressiveness, timing, and skill. And if you have enough aggressiveness at the right time, i.e. the market's low, you don't need that much skill. What I say and tell people is aggressiveness is asset allocation, right? How aggressive should I be? Should I be really aggressive, 80% of my money in stocks, or should I be not aggressive, 20%, right? Timing and skill I look at in terms of market cycles and market valuation, right? Timing, market cycles, right? Skill is market knowledge, which we talk about in risk, right? How much do you know about the asset class that you're buying into, right? I don't really understand Bitcoin that much, so I don't get into it, right? You understand a lot more than me, you're into it, right? And that's where people like Warren Buffett are really good. Do I know about this? No. Okay, well,
I'll leave it alone.
leave it alone, right? And the more successful you are in the investment process that you've got, the more you say, well, I don't need to run into Bitcoin in my case, right? Because I know how to do it in well 1, 2, and 3.
Yeah.
You know, if you're in Bitcoin and you're doing really well, I don't need to do property investing because I know what I'm doing in Bitcoin. Okay. And that's where the skill part comes in. I was saying to my daughter yesterday, I think she said something about some event, you know, and she went, oh, even if it's 1,000,000 to 1, I'm not interested. And I said to her, you know, in terms of probabilities and risk, and I said, you know, there's an old golfer called Gary Player who was a champion, and he said, the more I practice, the luckier I get, right? And it's so true. The more knowledge you get, part of that being, like for me, is just getting older and reading more and more and more and more. You build a bulk, you build a foundation of knowledge where you know where the risk is, right? Where
you pick it up earlier.
Well, yeah, you just look at something and go, nah, that's too risky. And it might be because I know about market cycles, because I know about the difference between buying an individual company, which can go bust, or an ETF, which can't, right? An index ETF, right? Those things are really simple, but you've got to have the ability to say, I'm going to stick to my knitting like Buffett has done for 70 years, right? I'm buying value. Buffett's not in there going, man, the market's booming, I've got to get in and buy NVIDIA, right? He's just like, I got my process, it works over the long term, and that's what I'm sticking with, right? And that's the way it works.
Yeah, finding and establishing that process is people usually take a little bit too long because they fail. They try something, fail, and think, oh, it doesn't work, and move on to the next thing, and they don't actually get good at one thing.
Yeah. Well, look, Jacob, it's hard, you know, because even if you do a good process and it works in the long run, if you join it and then it starts losing, you start going, oh, this is bullshit, this is not working. But you don't even know that you've got to give it, you know, 5 years, or you've got to adjust your asset allocation, or maybe you're risking too much, or, you know, have you thought about your own personality? You know, have you thought about external events? Have you thought about the market being 38, right? All this sort of stuff, you know. So that's why we say it's tricky, you know. And when I started out, every single book I read was me. Technical analysis, that's where it's at. Yeah, I know what I'm going to do now. And then I'd read a book on Warren Buffett. I need to be a value investor like Warren Buffett, you know, buy good companies at a reasonable price. You know, read Ben Graham, Buffett's mentor, right? No, what I need to do is to buy, you know, companies that are less than book value. You know, like every time you read a book, you go, well, I do. Anyway, you sort of go, yeah, okay, that's the investor I should be.
Yeah.
Right? I could read a book on Bitcoin and go,
got it.
I've got it. I know what I'm doing now. Okay, let's go. Right? It's just the way it happens.
Yeah.
And it takes you a while. And that's why I say to young investors, be really careful. Right? Be really careful, because the worst thing you can do is win. Right? Because then you think, now I've got it how it works. This is easy, this stuff, right? And you know, Ken Fisher, great investor, called the market the great humiliator, right? And it does, you know, like you're up a mozza and you're thinking, oh man, this is great, you know, and then it's just like,
you get humbled really.
You know, and it's embarrassing, and it's, you know, you look at it and go, oh man, look at the money I left on the table, you know, like it's just crazy. And of course it happens more the more you make.
Yeah.
Right? And then, like you said before, you sell and it goes back up. You know, and then it's like, oh, no. You know, like it's just like being smashed with a baseball bat, you know, at every stage. It's just awful.
Yeah, but it's great at the same time.
Oh, yeah, absolutely. I wrote to a guy one fella on Thursday, I think, and said, you know, the market went up like 2% or 1% or something. And I said to him, you know, even after 25 years, I just love it when the market goes up, right? It's just, like you say, it's just really, you know, it's everything. It's got economics, behaviour, science, you know, psychology. It's just a really great field. You know, it is really addictive.
All right, let's finish on the we got a question from Liam on Instagram. So he's saying, "Hey guys, love the podcast, enjoying the clips, blah blah blah. The way you talk, it's like there's nowhere good to invest. Is that the truth? I was recommended ETFs and I've invested in a few, but a lot of them have great percentage of American stocks, which seems to be something you are pretty bearish in at the moment. Where should I invest, do you think?"
Well, we can't tell you, but generally what we do in educating people is showing them what I like to do is show people the facts. Now, if you say to me, I don't give a shit about that, I'm going to invest in NVIDIA, good, no problem. But I'm just showing you how it works over time, okay? And if you want to reject that, by all means. But the idea is not, and again, you know, the answer to Liam's question is, yes, the US market is really, really expensive, but there are other places to invest, right? Or there are other ways to invest, right? So maybe about 6 months ago, we introduced technical analysis into the newsletter to say to people, look, if you said, Steve, I'm only investing until Friday, I don't give a shit about that CAPE thing. It's like, okay, well, this is the way you do it, right? Listen, Steve, I've got 6 months. Okay, well, this is the way you do it, right? And it might be more asset allocation, but more rebalancing, right? All that sort of stuff. So there are different ways to make money. A lot of the stuff gets caught up in it's expensive, so I can't make any money. And that's not the case. It's simply just saying, again, what's your time frame? What's your risk tolerance? You know, do you need to go crazy? You know, do you realise that the market fluctuates and that will become cheap? Do you realise that there are cheap countries even when America's really expensive? You know, that sort of stuff, right? And again, different asset classes, right? Go and learn about Bitcoin. Go and learn about investment properties. Go and learn about stocks. Go and learn about bonds, right? All that sort of stuff.
Cool. Hopefully that'll help, Liam. All right, well, let's wrap it up there. As always, we've been talking a lot to the charts today, so if you don't have them in front of you, there's two ways. You can either watch us on YouTube, where you can see, or Spotify videos, where you can see what we're talking about, or go and download the week that was through the website. It's free. All right, we'll see you next week.
Cheers. Thanks, folks.
As always, remember, we don't provide financial advice.